Welcome to our session today. I am your instructor, CPA Aringo Frederick. In our class today, it is a continuation of what we started earlier on. Remember in the previous class, we had introduced the taxation of limited companies, and also we had a brief intro on some of the concepts that you must always tend to be very good at. In our session today, I want us to cement that knowledge very well. And to do that, we are going to handle an illustration question from our past paper. And the question that we are going to do, that question was tested in May 2021, question number 4. A question which was tested in May 2021, question number 4. That's the question that I want us to handle today. So for those who have the past papers, kindly let us go to that question, May 2021, question number, of course, 4, part A. For those who are using our phone application, just below this video you have a PDF download. Just download the PDF. For those who are using our web application, it is above this video. We do have a PDF download. Kindly download and let us go through that. For those who are watching us via other medias, I'm going to share this question on our screen so that all of us, we should participate in this question. So this is a question that I want us to handle. May 2021, question number 4, part B. And the question that we will be handling, I've just shared it on the screen. So this is what we are told. We are told that I'm having Jamji Manufacturers are Limited. Jamji Manufacturers are Limited presented the following statement of profit and loss and other comprehensive income for the year ended 31st December 2020. And what I am given, it is number 1, we are given turnover. For turnover, I was given 384,900. Cost of sales, I'm given there. Gross profit, I'm also given at that point. Our other incomes. Our other incomes, the item that I'm given, number 1, we are talking about gain on foreign exchange transactions. I'll explain this point before we continue. Anytime we do have gain on foreign exchange transactions, my good students, this is what must always stick at the back of our mind. We must always consider and make that assumption if it is either realized or unrealized, in the event that the examiner is silent. As you can either assume realized or unrealized, but I'll always advise that we go with realized. If it is realized, we are going to take gain on foreign exchange transaction as what? As part of our business taxable income. And therefore, if it is taken as business taxable income, is going to be taken amongst the business incomes. In the event that probably you've decided to go with an assumption that it was unrealized foreign exchange gain, or if the examiner has told you that it was unrealized foreign exchange gain, what you need to do, you need to take that as non-taxable income, and therefore you're not going to aggregate it amongst your other incomes and tax further. And if it was included, you'll have to deduct it for you to arrive at your taxable income. That is one thing that must always tend to stick at the back of our mind. We have capital gain on sale of motor vehicle. Capital gain, my good students, remember the concept of CGT. This is a capital gain tax. Capital gain tax is usually a final tax. Being a final tax, that means that it's not going to be aggregated to our principal activity income to be taxed further. And if in this case you are given there, you're supposed to take it as what? Non-taxable income. Non-taxable income, okay? Refund of import duty, that is a refund of tax, therefore being a refund of tax, non-taxable income. Investment income, the examiner hasn't told us anything in relation to that, so therefore we are going to take it as what? As non-taxable, or rather taxable income, but other incomes. Mark that word very clearly. Taxable incomes, but other incomes. We do have less expenses. In our expenses here, we are given the following. We are given, number 1, purchase of copyrights. Purchase of copyright, always take that as what? Non-taxable income. That's a capital expenditure. Design of a company website. Design of a company website. These are software. And software, remember, it was revised, and now software, it is in class 2. And class 2, basically, it is in summary of what? Class A. So let Mwalimu explain this concept clearly for capital allowances. Anytime from 2020, anytime we will be talking about capital allowances, this is what must always tend to click at the back of our mind. For WTA specifically, we have in summary class A items and class B items. So what will class A constitute? Class A will constitute the following. Class A will constitute class 1 items, believing that you can still recall the examples and items in class 1. Class A will also constitute class 2 items and class 3 items, which in this case, this will fall under at what rate? 25%. This will be at the rate of 25%. What about class B items? Class B items will be will comprise of class 4, which in this case I'm having class 4 and special rate class, or rather special class. So in this case, we do have them at what rate? At the rate of 10%. So kindly always have that in mind. And another key element that again you should have in mind is that initially we used to take software to be amongst our special class, but from 2020 in this case we will be taking software in class 2. In class 2 you can clearly see it is falling in what? Class A, or rather category A. So this is one concept that you must always have in mind anytime you're handling taxation, and specifically the component of capital allowances, WTA to be precise. After we've looked at that case, we proceed to this other bit. We are told that directors are having design of a company website, so therefore that will fall under software class being taken to class 2, or in summary, class A item. Okay? Then we are also given, directors' fees, allowable expenses, donations to charitable institutions. At any given point, you do have donation to charitable institution. This one will always be taken as what? As allowable expense. But if you have donation to a political party, that is when it will be taken as what? Non-allowable expense. We are given depreciation expense. That, of course, that one is non-allowable expense. Advertisement expense, that one is allowable expense. Depreciation, non-allowable. Advertisement, allowable expense. Professional fees, unless I'm given further details in relation to that, but generally professional fees are taken as allowable expense. General expenses, allowable expense, unless I'm given further explanation on the same. Legal costs, the same case, allowable expense, unless I'm given explanation on the same. Loan repayment, this is kind of I'm repaying my liability, and therefore in that case that is an allowable expense if it was taken there. I'm also given here, we also given provision for bad debts. Again, Mwalimu would want to explain something on provision for bad debts. This is what must always tend to stick at the back of our mind. Anytime, my good students, anytime you're talking about provision for doubtful debts, anytime you're talking about provision for doubtful debts, you should always recall this. We have two: general provision, and we have specific provision. So if we are to talk of a general provision, this one is non-allowable expense. And if we are to talk about specific, this one is allowable expense. So kindly always have this in mind. And when we are talking about bad debts, these are actual bad debts that have been written off. These are actual expenses. And actual expenses, in this case bad debts, it is what? A liable expense. So I want you to understand this concept here clearly, a liable expense. I want you to understand this concept here clearly. In this case, you are saying that provision, this is an estimation, okay? Being an estimation, we have to consider if it is either general or specific. For general, non-allowable, specific, allowable expense. And when we're talking about bad debts, actual expenses that have already been incurred, we are going to take it as what? As allowable expense. So this is one main concept again that you must always tend to have at the back of your mind. Don't confuse the bad debts that have already been written off and provisions. And by the way, anything provision in tax, anything provision will always be taken as what? As non-allowable expense, unless it is provision for specific doubtful debts. That's the only provision that will be taken as allowable expense. So after we've explained that one, let us proceed. In this case, you are given so we have general expenses, we have provision for bad debts, we've looked at it. Impairment, loss of a building. Impairment will always be taken as non-allowable expense. Come to our additional information. Our additional information note 1, we are told on 1st July 2020, the company acquired Gilo Limited, a manufacturing company, for 56 million and took over all assets and liabilities, which included factory building, furniture and fittings, processing machinery, lorries, computers and printers, delivery van. I'm also given here the aspect to do with liabilities, 15% bank loan, trade payables, and bank overdraft. We are told that Gilo Limited had operated for only 6 months and had not claimed any investment allowances before it was closed down by the environmental authority. So basically, at this point, you can see that two things are happening here. We do have these firms, we do have these two firms. Look at this case, my good students. We do have Gilo, and we do have now our company, which in this case we are looking at our books, which is Jamji Manufacturers. So we are talking of acquisition. And anytime we do have acquisition of another company, for the purpose of capital allowances, we will have to draft all the assets and liabilities that have been acquired to the cost of acquisition, which we'll see how we are going to treat that. After we're done with that, let us proceed to the next bit here. We do have note 2. We are told that turnover includes goods sold to company's branch of 72. It was established that at the end of the accounting period, 20% of these goods had not been sold by the branch. Okay, note 3. So in this case, we will be having a component of unrealized profit. For unrealized profit, we will always deduct the unrealized profit in our books. So kindly have that in mind. Come to note 3. We are told that professional fees included management fees. That one is allowable expense. Tax consultancy fees, allowable expense. Audit fees, that is allowable expense. Preparation of tender documents. Preparation of tender documents, in that case, you're going to take it as what? Non-allowable expense. Non-allowable expense. Environmental assessment fees, in this case, you are going to take that one as what? As allowable expense. Note 4, we are told general expenses included. Number 1, installation of neon sign. Neon sign, remember we mentioned that this is a capital item. Being a capital item, which will also qualify for capital allowance, by the way, which is category B, class 4, at the rate of 10%. Car grant to a director, that one is of course non-allowable expense. Partition of an office block, this is an item of a capital expenditure qualifying for capital allowance, class B, at the rate of 10%, which is class 4. Directors Christmas party, of course you know very well that is partly private, so take it as non-allowable expense. branch closure costs. At any given point, whenever you do have branch closure costs, in this case, you're going to take it as a liable expense. Repayment of hire purchase loan. These are loans that I'm paying, and being a loan that we are paying, we are going to take it as non-allowable if at all it was included in our expenses in our statement. Now we are told note 5, legal costs comprised of drafting sale agreement between the company and Jijo Limited. That one is of course allowable expense, drafting of a sale agreement. Talk about defending a company against breach of contract, non-allowable expense. Negotiating a bank loan. These are cost of acquiring a loan, being taken as non-allowable expense. Preparing copyright documents. This will be capitalized in our copyright cost, so therefore being taken as non-allowable expense. Drafting lease agreement, 50 years. Anytime you do have lease agreement less than 99 years, you are going to take that as what? Now, allowable expense, as allowable expense. Note 6, provision for bad debts include 15% of debts amounting to 600,000 from a company which was declared irrecoverable. So in amongst our provision, in this case the examiner was silent, but there I forgot to mention that one. In the event that the examiner is silent, we will always take the provision for doubtful debts as general, and therefore non-allowable expense. But the examiner is telling us that in our provision for doubtful debts, I'm having 15% of debts amounting to 600,000 from a company which was declared irrecoverable. So 15% of this amount, we are going to remove them completely, and therefore taken as bad debts. Then note 7, we are told that the corporate tax rate during the year was 25%, so we need to determine our corporate tax, which we are given there. Note required, we are told, a statement of adjusted taxable profit or loss for the year ended at 1st December. And anytime we are being asked to prepare a statement of adjusted taxable profit or loss, the approach that should click at the back of our mind is reported profit approach. That's an approach that should stick at the back of our mind, reported profit approach. You will have to consider that. Tax liability and installments for the year 2020, assuming that the actual profits were made. So we are told to work out installment. And in our last class, recall, we had a component to do with installment tax. So basically, the moment you've gone through that question, it will be very, very easy now for us to handle that. And where will be our starting point? Always in such a questions, my good students, what you must always tend to remember and have at the back of your mind is you must always ask yourself the approach that you're going to use to prepare your statements. And we normally tend to talk of only two approaches. These are reported profit approach and gross profit approach. Good question will be, at what point will I use either of the approach? In the event that you are asked to determine the statement of adjusted taxable income, the best approach to use, if you're not given any other further instruction, will be reported profit approach. In the event that the examiner has asked you to determine the taxable income, the approach that you're supposed to use is gross profit approach, if at all the examiner hasn't given us any further instruction. So the moment we've identified our starting point, it will be very easy for us to work it out. And in this question of ours, we are going to start with our additional information. And actually, it is always very advisable that anytime you're handling questions for either tax or a FAR, the best way, or any computation question, the best way is always to deal with additional information first. And that is what you are going to deal with. So, additional information note 1, what were we told? We were told that I'm having this company which we acquired another company. I'm having a company acquiring another company, and in that case we are acquiring the assets on that company. So this is what we'll have. I'm having two cases, Jamji. So allow me to, because I know we've taken a screenshot of the question, so let us work it out quickly. So this is what was happening. I'm having Jamji Manufacturers Limited. We had Jamji Manufacturers Limited. Jamji Manufacturers was acquiring Gilo Limited. Was acquiring Gilo Limited. And the cost of acquisition in this case, cost of acquisition, we were given 56 million. Remember, our figures were in thousands. And the assets that were assets and liabilities acquired were the following. So I'm having the factory building. So assets and liabilities acquired, we had factory building. I'm having a factory building, which in this case I was given the cost of which and took over all the assets and liabilities, which included factory building. Remember, these were in the books of who? These were in the books of Gilo Limited. The assets that I'm given here were in the books of Gilo Limited. So these assets were the following. These assets were the following. I'm having 14,800. Furniture and fittings. We do have furniture and fittings. Furniture and fittings. We had a figure of 1,400. Processing machinery. Processing machinery. Processing machinery. We had a figure of 8,600. Lorry, 4 tons. Lorry, 4 tons. We had a figure of 1,500. Okay, I'm writing exactly the figures that you are given, which I believe we can all have them there. Which I believe you can all have them in our papers. Then we are also given, I'm having lorry. We do have computers. Computers. We were given a figure of, that is computers and printers, so allow me to use P. Computers and printers, we are given 600. We do have delivery van, delivery van, delivery van, delivery van. Delivery van, you are given a figure of 840. Talk about liabilities, 15%, 15% bank loan, 15% bank loan. I'm given a figure of 6,000. Remember, our figures are in thousands. Trade payables. Trade payables. Trade payables here. I'm given a figure of trade payables. I'm given a figure of 1,720. Bank overdraft. Bank overdraft. For bank overdraft, I'm given a figure of 1,480 here. So these are the figures that you are given, my good students. What you acquired are what you are given there. So in this case, what we need to do is we want to determine the cost of these items in Jamji Manufacturers Limited. Because remember, the cost of these items that you are given, they were under Gilo Limited. So our main purpose is to determine the cost of these items to who? To Jamji Manufacturers Limited. And how will we go about that? So you'll have to determine the proportion of each item to this cost. We'll have to determine the proportion of each item given here to our cost of 56 million, the cost of acquisition. So determining the proportion of each item, meaning that, first of all, I'll have to determine the total of all this. Let us determine the total of all the items given there. The total of all the items given there. That will be our first procedure, determining the total of all the items given there. And to do that, let us pick our calc quickly. We work it out. So I'm having 14,800 plus 1,400 plus 8,600 plus 1,500. We have plus 600. We have plus 840. We have 6,000. We have 1,720. We have 1,480. So I'm given 30. We are determining it to be 36,940. Kindly confirm. For me, I'm getting 36,940. I'm getting 36,940. Kindly confirm your figures. Now, determining the proportion of these items to the cost of acquisition. Determining the proportion of these items to our cost of acquisition. How will we go about that? So like in the first case here, we know very well that we are going to talk of 14,800 of 36,940. We multiply by 56. Take our figures now to be in thousands, because remember, we are given our figures in thousands here. The other case, the same case, 1,400 of 36,940 times 56,000. 8,600 of 36,940 times 56,000. Took about 1,500 of 36,940 by 56,000. 600 of 36,940 by 56,000. Took about 840 of 36,940 by 56,000. Took about 6,000 by 36,940 by 56,000. Took about 1,720 of 36,940 by 56,000. And the last one is 1,480 of 36,940 by 56,000. So we want to determine the proportion of each item. We want to determine the proportion of each item to the total cost of acquisition. And that is what Mwalimu is doing here. So the moment you do have that case, come and determine the proportion of the first one. 14,800 divided by 36. That is, of course, 14,800 of 36,940 by 56,000. That should give us 22,436. Kindly confirm. I'm getting 22,436. That is, of course, 14,800 divided by 36,940 times 56,000. We're having 22,436. The other one, furniture and fittings, 1,400 of 36,940 by 56,000. That should give us 21,22. 8,600 36,940 by 56,000. That, of course, should give us 13,037. 1,500 by 36,940 of 56,000. That should give us 22,074. 600 divided by 36,940 times 56,000. That should give us 910. 840 divided by 36,940 times 56,000. That should give us 1273. 6,000 divided by 36,940 by 56,000. That should give us 96. And of course 1720 by 36,940 by 56,000. That should give us 2607. And the last one, 1480 divided by 36,940 times 56,000. That should give us 2244. 2244. So that if we sum all these figures, it should take us to the cost of acquisition, because this is what you acquired. So therefore, we should be talking of 22,436 plus 21,22 plus 13,037 plus 22,074 plus 910 plus 12,073 plus 1996 plus 26,07 plus 22,44. So that should give us, of course, 55,999, meaning that it is just the same as 56,000. just the same as 56,000. So therefore, in this case, we should be having 56,000, which in this case, it was 56 million. So the moment you do have that case, my good students, that's the first thing that you need to do. And clearly, we can see that these items are capital allowance items. So therefore, actually, to make our work easier, we can just proceed and determine our capital allowance at once. So factory building, you know very well that this is an ID item. And for ID, recall from 2020, looking at the capital allowances rate, we normally tend to say that you're going to provide 50% in the first year, then 25% subsequent years. So here we are talking of at the rate of 50%. Okay. We do have furniture and fittings. That is of course class. That is of course class B, and class 4, 10%. Processing machinery ID, 50%. Lorry, that is of course class A. In this case, you're talking of, in this case, this is WTA. This is now WTA. This is now WTA. This, we say that this one is ID. Remember, this one is ID. This one is WTA. This one is ID. Okay. Lorry, that is 25% WTA class A. I'm writing this so that you guys should understand. I'm talking of the computers and printers. This is, of course, 25% class 2 WTA. Delivery van by 25%, that is WTA. Of course, you're talking of class 3, or talk about aspect to do with what? Aspect to do with class B. So up to this point, this is where we're having our assets, providing them for capital allowances. In our case, bank loan, trade payables, and bank overdraft, we'll see where we are going to use it. Because preparing our statement, we won't be required to use these items, but you can just mark them somewhere. Maybe you can use them later on. We never know where you can use them. So I'm having 6 million bank loan. I just want to drop them somewhere. Trade payables, I'm having, that is of course, bank loan, I'm having 1996, what we've acquired. I'm having 2607, trade payables, and talk about bank overdraft. We do have 2204, 2204, 2244. So we won't use that. We won't use this one maybe unless you're supposed to prepare our statement of financial position. Now, the moment you're done with this case, my good students, let us now proceed and talk about the other items for WTA so that we handle them here at once. Items for WTA, I think we had marked them according to additional information. Let us proceed to additional information. So for now, we are done with part additional information 1. Talk about additional information number 2. Turnover includes, that one you're going to work it out. That is not a capital item. Note 3, I'm having note 3, note 4. Note 4, we had installation of neon signs, right? So talk about installation of neon sign. So I'm having neon sign here, neon sign. Talk about neon sign. For neon sign, in this case, you can clearly see neon sign. I was given a figure of how much? 420. And neon sign, you know very well that that one is under, of course, class 4, or rather in this case, talk about class B at the rate of 10%. So that one is WTA. Okay. Then proceed to our other information here. Note 5, no item. Note 6, no item for capital allowance. Come and look at our statement that I was given on top there. Identifying our items, we had company website. Actually, we only had the company website, right? We only had the company website, so that is what you're going to consider. Company website. So you should be having a company website. Talk about company website. Company website. company website. For company website, in this case, my good students, you are given a figure of how much for company website. You have your paper. I was given 1200. Our company website was given 1200. Having our 1200, therefore, I'm not seeing any other item for capital allowance. So that one is what? By 25% WTA. So therefore, what should be our total capital allowance? Actually, we just decided to work it out like this so that we just clear the capital allowance completely, being our workings. Term this as our working number 1. So on that case, our capital allowance in the first case, we should be talking of how much? That is 22,436 by 0.5. That should give us 11 to 18. 21, 22. This one should give us 12 to 12.2. 13,037 by 0.5. That should give us 6518.5. 2274 by 25%, that should give us 568.5. 910 by 0.5 by 0.25, that should give us 227.5. 1273 by 0.25, that should give us 318.25. For 20, of course, that should give us 42, and the other one that should give us 1200 by 0.25, that should give us 300. So determining our total capital allowances, what would we have? Determining our total capital allowance, we should be talking of 11 to 18 plus to 12.2 plus 6518.5 plus 568.5 plus 227.5 plus 318.25 plus 42 plus 300. So you should be having here a total of 19,404.95 being our capital allowances, So in that case, let's see if we are done with that case. So in that case, we are done with that bit. Now proceed to the next bit here. We should be talking of note number. Look at note number 2, other item to consider. Note number 2. Note number 2, we are told that turnover includes goods sold to the company's branch of 72 million. It was established that at the end of the accounting period, 20% of these goods had not been sold by the branch. So therefore, at that point, note 2, my good students, let us determine unrealized profit. So I take it as working number 2, unrealized profits. Unrealized profit. What should we have in our unrealized profit? This is what you're going to consider in our unrealized profit. We should be talking of the turnover. The turnover includes goods sold to the company's branch of 72 million. So goods sold to branch, amounted to 72 million. Out of the 72 million that was sold to branch, I'm having a percentage which had not yet been sold as at the end of the financial year, which was at 20%. This was still in stock. It had not yet been sold. So therefore, our unrealized profit on these goods, we should be talking of 72 by 0.2 to give us 14,400. This will be our unrealized profit. Unrealized profit, you are going to deduct it. In this case, we noted that we'll be using the reported profit approach. So therefore, we are going to take this unrealized profit and deduct them from amongst the also non-taxable incomes and so on. So after you're done with the note working number 2, Proceed to note number 3. It not affect us at this point. No workings for that. 5, no workings. Note 6. Provision for bad debts include 15% amounting to 15% debts amounting to 600,000 for a company which was declared irrecoverable. So, provision for bad debts include 15% of debts amounting to 600,000 from a company which was declared irrecoverable. So, from our provision of bad debts, our provision of bad debts on top there, I was given 142,000, right? So, in this case, we want to take provision for doubtful debts. Working 3, we are talking of provision for doubtful debts. 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 So this is what we are told, that I'm having our, first of all, whatever that was given on statement, whatever that was given in our statement, we had a figure for much? 142. That is what I was given. Provision according to our statement was 142. Remember, we are talking of the concept of provision for doubtful debts. Then we are told that out of this, I'm having bad debts. Bad debts out of that we had bad debts because he was a declared bankrupt. I'm having 600,000 by 15%. 600,000 by 15%, that should give us 0.15 by 600,000.